Hello, and welcome to this short video on the end of the student loan COVID forbearance and how you can start planning today. I'm Amy Lenz, Vice President of Enterprise Learning at Money Management International, and today we're going to talk about how to prepare to resume payments on student loans. Until the recent announcement, the student loans are going to remain in forbearance until May 1st, 2022. You probably felt a little like this. Like one wrong move and the whole thing might just fall down. And now that you've heard the news, it may feel like this. You're ready to celebrate because you don't have to worry about payments until May. But today's celebration could turn into tomorrow's worry. So we want to help you build a solid foundation and a plan for repayment so that when May 1st gets here, you'll be ready. Step 1 is to review and adjust your budget. If you haven't taken a look at your budget in a while, it's time to review your income, your expenses, and how those two compare. This is Maurice, and Maurice is in your shoes. Maurice has student loans, and he hasn't been paying on them in the last 22 months. Because of that, student loans isn't even on his budget. He hasn't had to think about it, and his other expenses have adjusted over the last 22 months to absorb most of his income. Now's the time for Maurice to put that student loan payment back into his budget and see how that equates with his income and his other expenses and where he might need to make some adjustments. Now's the time to add that student loan back into your budget and try to live with that budget. For example, you could pay yourself the same amount as your student loan payment and put it aside in a savings account and see if you can live on this budget for the next few months. You can establish emergency savings and you'll have a little cushion to start repaying your loan. Or you may find that you can't live on your new budget, and then you'll have to make some adjustments. Let's take a look at Maurice's situation and see what he discovered. So Maurice is going to make a written budget and include his student loan payment. Now, if Maurice doesn't remember how much his payment is or when it's due, he can log into his servicer portal and find out. So that's a very important step in the budget plan. Maurice might have to look at some trade-offs to eliminate any deficit that he has between his income and his expenses after adding back student loans. Once Maurice adds his $500 worth of student loan payments back into his budget, he finds out things just don't add up for him. He has $100 of an excess right now, meaning he's got to find $400. Maybe for you, you can trim your budget and cut back on other expenses or increase your income in some way. But for most people, that's not going to be realistic. So what are Maurice's options if he's not able to make other adjustments in his budget? If Maurice can't adjust his budget to cover his student loan payment, then the next step is to look for an affordable student loan payment. Let's take a look at the options now. There are two types of repayment plans, time-based and income-driven. Within each type of repayment plan, there are several different plans. On the time-based plans, you're paying for a fixed period of time. For the standard and graduated plan, that's 10 years. If you have more than $30,000 of debt, then you can use the extended or the extended graduated, which will let you pay out over 25 years. You get a much lower payment because you're paying for a longer period of time. However, you're going to pay more in interest. So the standard plan of 10 years typically will help you pay off the fastest and pay the least amount in interest. Now, the graduated plan is also 10 years, but it allows you to stair step up in your payment. You start with a lower payment, and every 2 years, your payment will reset to a higher amount. So you start with a low payment, you end with a higher payment. You do pay a little more in interest, but it can help you out. So the time-based payment plans are one option that you can choose. The income-driven plans work differently. They're not based on a set amount of time. They're based on a percent of your discretionary income. Now, each plan calculates that a little differently. Ultimately, though, your payment could be as low as $0 or a very reasonable amount, something that would be affordable for Maurice to fit into his budget based on his income and his family size and his state of residence.
Now, because the payment can be so low, the payment might not be covering the interest that's accruing. That's called negative amortization. That's not really going to help you reduce your balance. Your balance is going to increase. So, to offset that, some of these plans have introduced interest subsidies that help repay part of that interest if your payment isn't covering it. Now, because these could go on for many years at a very low payment with the interest not being covered, you could end up with an increasing balance. If you switch to an income driven plan, do you have to stay on it? Well, no, you could switch back to a standard plan at a later date when you're back on your feet and you're more able to make your payments. That's up to you. And your income plan may change over time because remember, it's based on a percent of your discretionary income. So if your income increases, then your payment might increase depending on the plan. So, how do you figure all this out? The easiest way to look at all the options and find the best one for you is to go to the student loan simulator found on studentaid.gov. You'll log in with your FSA ID, which is the same one you used to fill out the FAFSA when you were going to college, and you will do the loan simulator with your actual loans. Now, I have some sample loans here that I'm using to show you how it works. So, as you can see here, it will show you each of the plans that you're eligible for based on the types of loans you have, along with the monthly payment or range of payments. For example, if it's graduated or extended graduated or one of the income plans, the total you'll pay and when you'll pay off, and any amount that will be forgiven. Remember, we said some of the income plans might have a forgiveness amount at the end, depending on your payment based on your income. Now you can see that the amount that Maurice will pay in this example varies quite substantially from plan to plan. He may pay more on certain plans than others. Now keep in mind, this is all based on estimates of future income. Your income based plans are really made for people with a low income compared to the loan balances that they owe. So, whether or not this works out over time for Maurice will depend on whether his income remains the same or goes up. So, if his income goes up on one of these plans, he might end up paying more and have less of a forgiveness amount. But this is a good example of how different the payments might be, how different the total paid and the forgiveness amount might be under different plans. And also, if you're interested in public service loan forgiveness, there is a toggle switch you can turn on that will show you what your payments would be if you are going for the 10 years or 120 on time payments under the public service loan forgiveness. Maurice decides on the revised pay as you earn plan or repay. He will have a $79 a month payment, which fits into his budget. Remember, he only had $100 to work with, so this will actually work with his budget. He can sign up and apply for this right online in the loan simulator, or he can contact his servicer. Also, if you're already on an income based plan and your income has changed during the pandemic, you do not need to wait until your recertification date for your income. You can contact your servicer and have them rework your income based plan with your new income right away. It may lower your payment and make it more affordable.
Also, be on the lookout for scams. You can do this for yourself and you can do it for free on the studentaid.gov website or through your servicer. Don't pay someone to sign up for a repayment plan on your behalf because you can do it for free.
So we've looked at the budget and we've looked at the repayment plans. So, what else does Maurice need to think about? Well, he really needs to make sure he's up to date with his servicer. Read and respond to all servicer correspondence. They're going to be sending you information about resuming your payment, whether that's electronic or in the mail. You need to be paying attention and looking for those things. If you were on auto debit prior to the payment pause, don't assume that that will automatically resume. In fact, if you have not been making payments during the forbearance, you will have to authorize your servicer to resume auto debit. If you've never been on auto debit, now's the time to think about adding that as an option because you will get an interest rate discount of 0.25% by going on auto debit. Some servicers might allow you to log in online and make your debit authorization, so check with your servicer to be sure. Because you'll be receiving important correspondence from your servicer, it's important that your contact information is up to date. Now, a lot of people have moved during the pandemic, and maybe you really haven't thought about going in and updating that contact information on your servicer portal. It's important that you do that. Go into the servicer portal online and update your contact information, and also go on to the studentaid.gov portal and update it there as well. It's really important that both the Department of Education and your servicer are able to contact you. Well, what if you've done steps 1 through 3? You've looked at your budget, you've tried the loan simulator, you've read your correspondence, and you've updated your information with your servicer, but you aren't able to afford a payment, even an income based one. Well, remember, those income driven payments can be as low as $0. So you really should be able to find an income driven payment plan that's going to work for you. But if you can't, there are other options. Let's take a look at other payment postponement options that might be available to you. If Maurice can't make his payment, even with an income driven plan, then it's time to review his options to transition to a federal student loan deferment or a mandatory or discretionary forbearance. Eligibility for non COVID deferment or forbearance will depend on the type of hardship that he has. A deferment is a temporary postponement of payments, while a forbearance is either a reduction or a postponement in the payments. So, what's the difference? Well, for one thing, if you have subsidized federal student loans, when you are in periods of deferment, then the interest is subsidized and does not accrue. Whereas in a forbearance on either type of loan, subsidized or unsubsidized, that interest is going to accrue. So a deferment might be a better option if it's available. Deferments are available for those with economic hardship, unemployment, and other situations such as being treated for cancer or being called to active duty military service. Forbearance is available for similar reasons, including financial difficulties, medical expenses, changes in employments, and a few other reasons. Now, again, the main advantage is that interest will not accrue on subsidized loans during deferment. Both deferment and forbearance do have eligibility criteria and limits on their duration and their use.
So borrowers who need a post-COVID forbearance should reach out to their servicer before the current COVID forbearance ends. Right now, that's scheduled to end at the beginning of May 2022.
Now, remember, for unsubsidized loans, you are going to have to pay interest that is accruing while you're in forbearance or in deferment. And for subsidized loans, you will have to pay for interest that accrues while you're on a forbearance, but not on a deferment. Well, you should also look at those income driven plans, particularly the revised pay as you earn, because the revised pay as you earn will pay for unsubsidized loans a 50% interest benefit indefinitely. So that is really a great advantage over forbearance or deferment if you have unsubsidized loans and can make a small payment that might be offered under that revised pay as you earn plan. For those with subsidized loans, you will receive 100% for the first 3 years of interest subsidy and 50% indefinitely. Now, that also might be an option so that deferment or forbearance are not needed. So, really look at those income driven plans, particularly the repay, if you're looking at maybe a low payment as low as $0. That might help you out and you wouldn't have to use deferment or forbearance. What we absolutely don't want to do is go into a delinquent or default status. Delinquency and default are serious. Delinquency occurs when you've missed one payment or you've made a partial payment. You will remain delinquent until you've made up the missed or partial payment. If you are delinquent for 90 days, then your servicer will begin reporting that delinquency to the credit bureau, which will impact your overall credit worthiness and your credit score. You can contact your servicer to go on an income driven plan in order to find an affordable payment that will allow you to make up the missed payments and get out of delinquency. Now, default means that you haven't made a payment in 270 days or more. Default is much more serious than delinquency. It's going to include collection activity that will include fees and interest on top of what you already owe, and your balance could really increase quite substantially. In addition, your wages could be garnished and you could have a treasury offset, which means that instead of receiving a tax refund, the Department of Education will have access to that to repay what you owe. So your consequences are really going to increase when you get in default, and you want to stay out of default if at all possible. If you are in default, then of course there are options, and your servicer can help you with different ways to rehabilitate that loan and get out of default. But you should not have to go into default if you are following these steps. If you are making your budget, contacting your servicer, looking at the different repayment options, choosing a repayment plan that can have a payment as low as $0, or going into a post COVID forbearance or deferment if you cannot make payments. So you want to stay out of default, you want to stay out of delinquency at all costs. And your servicer is there to help you figure out a plan in order to keep making timely payments. Maurice feels much more confident about restarting his student loan payments now. He and his wife, Clarice, sat down and made a budget. They determined how much they could pay for their student loans, and they looked for plans that would work for them. They used the student loan simulator and they talked to their servicer. They made sure they were set up for auto debit, and now they're all ready to go. They can relax as they move into 2022 and start the year out right. If you're struggling, MMI is here to help. Go to moneymanagement.org to look at all of the options that we have that might help you, including credit counseling, housing counseling, which is for both mortgage holders and for renters, and our student loan counseling. We have online counseling portals available for several of our services, and we are also available by phone. We can help you make a plan to get back on track today.